Good morning, students, and once again welcome to the lecture series on understanding profit and loss account statement. This is the second part of your understanding profit and loss account statement, and this is Dr. Deepa Srivastava, Assistant Professor, Indian Institute of Tourism and Travel Management. Now, students, in the first part we have already seen and we have already understood that what is a profit and loss account statement. We have already seen that what are the certain concepts which we have to keep in mind when we are calculating or preparing a profit and loss account statement. Now then, what will be the objectives for this session? In this particular session, we will try to understand the relationship between profit and loss account or the profit and loss account statement and the balance sheet. And we will also see the various terms which are related to your profit and loss account statement. Now, when we talk about the financial performance of the business, then at that particular time, certain financial statements are being prepared. And there are two different financial statements which we prepare to talk about the financial position or financial health of a business. Now, these two statements are, one is your profit and loss account statement and another is your balance sheet. Now, these two are very important and the purpose of preparing these two is also very different. Balance sheet, it shows the details of assets and liabilities and the owner's equity on a particular day. Listen this again, that it shows the details of assets and liability. I think we are very well versed with what is an asset. It is something which is being owned by the business. What is a liability which the business owes to others? And then we have owner's equity. That is the capital, anything which has been a part of capital of the businessman or the owners. And when we say balance sheet is prepared on a particular day, why? Because balance sheet is prepared on one particular day, that is the last day of the accounting period. But profit and loss account shows the earning capacity, the profitability or the results of your business operations for that particular accounting period. Now, we can say that profit and loss account statement or account is a flow report. Why it is a flow report? Because this particular statement or account shows the flow of assets and liabilities, or it shows the flow of income and expenses in an organization in a one particular year, accounting year. But balance sheet is a stock report. It is a report or it is a statement which shows the position of your assets and liabilities on a particular day. That is the balances of your assets and liabilities on a particular day. That is why we say that profit and loss account statement is a flow statement. It shows the flow, but balance sheet is a stock report because it shows the position or a balance on one particular day. Now, this profit and loss account statement or an account is basically a link between your balance sheet. You will have two balance sheets, one as an opening balance sheet, which is the closing balance sheet of the previous year. That will become the opening balance sheet for your current year, and then again you will have one balance sheet at the end of your current accounting period. Now, there would be definitely be change in the position of your assets and liabilities when you compare it with your opening balance sheet and your closing balance sheet. So these two balance sheets will show you different values or different balances of your assets and liabilities. Why this has changed? This position of your assets and liabilities or your owner's equity has changed because of your profit and loss account statement. Because profit and loss account is a flow report, it shows the inflow or the change or the flow of assets and liability, changes in the assets and liability, and because of that the position of your opening balance is very different from your closing balance sheet. Now, this, the same as I said, it shows the inflow and the outflow of assets and liabilities. That is why we call profit and loss account as a flow report. Now, as profit and loss account statement and balance sheet are the part of the financial statements which are being prepared by the business to show the financial position. What is the relationship between these two statements? That is very important to understand. So let us see what is the relation. Profit and loss account is a flow report and balance sheet is a stock report. Now, why we say profit and loss account is a flow report? Because it shows the flow, it shows the changes in the values of assets and liability of the business in that particular year. So whatever changes has happened because of the inflow and outflow of cash or the assets and liability, it is shown in your profit and loss account statement, and that is why it is a flow report. But balance sheet, it is prepared on one particular day. It is the position of your assets and liabilities on one particular day. That is why it is what? It is a statement which shows the value of stock, the balances, and that is why we called it that balance sheet is a stock report. This definitely a profit and loss account is a link between opening balance sheet and closing balance sheet. A business in this particular current year, they will start with the opening balances of your assets and liabilities, and these opening balances are taken from the opening balance sheet, that is the balance sheet which was there in the last accounting year. So the balance sheet of last accounting year becomes the opening balance sheet for current year, and then we will prepare a balance sheet for the current year, current accounting year, which is the closing balance sheet. If you look at these two balance sheets, there will be definitely a change in the value of assets and liabilities on these two particular dates. Why? Because the change is because of your profit and loss account. Why? Because of the flow because the profit and loss account is a flow, because it shows the changes in the value of assets and liability. So this profit and loss account will tell you how the values of your assets and liabilities have changed throughout the year, so that the opening balance is very different from the closing balance of assets and liabilities. That is why we say it shows the inflow and outflow. Throughout the year, some assets would have been sold, some liabilities would have been increased or decreased, some revenues would have been earned. So definitely at the end of the year, there will be change in the position of your assets and liabilities. So this profit and loss account is going to show you how the position has changed from the opening to the closing balance of your assets and liabilities. Now, when we understand this relationship between your profit and loss account and the balance sheet, this accounting equation is going to play a very important role. I think we all are familiar with the accounting equation. Now we will see how this accounting equation shows the relationship between your profit and loss account and your balance sheet. This profit and loss account shows the changes in the value of assets and liabilities throughout the year. That is, it will also show the changes in the owner's capital or the equity, how the capital or the equity or the money which belong to the owner changes between the opening and the closing balance sheet. This means that balance sheet cannot be prepared without your profit and loss account statement. You can prepare a profit and loss account statement without preparing a balance sheet, but for a balance sheet, you need to prepare your profit and loss account statement. This balance sheet is definitely going to show you the impact of revenues, the impact of income on your assets and liability. I think we remember what is the accounting equation. The accounting equation is assets are equal to equities. That is, assets, we can also say assets are equal to liabilities plus owner's equity. That is, anything which belongs to owner is owner's equity. Can we write it in another way, that what is owner's equity? Owner's equity is assets minus liability, that is owner's equity. So if we know two of these values, we can easily find out the third value. So this is a very easy way of understanding, or this is very easy representation of our accounting equation. Now, can we define the owner's equity this way? That owner's equity is equals to what? The capital which has been contributed, the capital along with the retained earnings also. Retained earnings means the profits which remain after paying for all the expenses and after paying for all the taxes. So what is owner's equity? Owner has the right to enjoy the capital, that is his capital, and along with that the profits, the retained earning, the earning which has been retained by the business, which will now definitely belong to owner. So owner's equity is contributed capital plus retained earning. Now, if there is no withdrawal from the business by the owner, if the owner does not take out any part of the profit, then what is retained earning? Simple. Retained earning is what? Your profit is equals to your retained earning. That is, revenues minus expenses is your profit, and that profit will become your retained earning because nothing is being taken by the owner. So that whole profit will become a part of retained earning and it will become a part of your owner's equity. Now, if we elaborate on that, can we write it that assets are equal to liability plus contributed capital plus retained earnings. Okay, this is another way of writing it. Then, can we write it in this way also, that assets are equal to liabilities plus contributed capital plus revenue minus expenses. That is, we have replaced retained earnings with revenue minus expenses. Why? Because we know that retained earning is what? It is revenues minus expenses. So we can see that yes, your profit and loss account statement is impacting your balance sheet. That is, whatever is happening, whatever profits are there in your profit and loss account statement, they will definitely go to the balance sheet and they will change the values of owner's equity in your balance sheet. So that means this profit and loss account statement is very important to be prepared before we prepare the balance sheet. Now, this accounting equation, it summarizes that all expenses and loss and revenues have to be shown in the profit and loss account, and it shows that total claims are equal to the total assets of the firm. It means that owner's capital or owner's equity and liability should always be equal to your assets. So from this accounting equation, we can easily find out that what is the relationship between profit and loss account and the balance sheet and how they both are related to each other. You need to prepare the profit and loss account and then only you can prepare the balance sheet, because the impact of your profitability, the impact of your profits, it has to be shown in your balance sheet because it is going to change your owner's equity. And when we are talking about or preparing the profit and loss account statement, there are certain terms which are very important. Definitely, we know that in profit and loss account statement, we have to write down all the incomes and we have to write down all the expenses also. But there are certain particular terms which we use when we prepare this profit and loss account statement. One is a gross sales. Now, what is the gross sales? Gross sales is your total sales. In a business, there can be two kinds of sales. One could be your cash sale and another could be your credit sales. So when we write the sales in your profit and loss account statement, we have to write gross sales, that is cash sales plus your credit sales also. Why? Because the realization concept says whether the money has been received or not, even if it is a credit transaction, if it has been done, it has to be recorded. So your gross sales is a total of your cash sales plus your credit sale. Now the same thing is applicable when we write the gross purchases. It is a total purchases done by the business, and again it is a total of your cash purchases plus your credit purchases. So total of your cash and credit purchases will become your gross purchases. Now, in a business, definitely there is always an option that whatever you have sold or whatever you have purchased, there is every possibility that some customers to whom you have sold the goods, they may return it, maybe because of any reason. So definitely when the sales are there, there will be sales return also. Similarly, when you are purchasing as a business, there is a possibility that some goods which you have purchased can be returned. You can return your purchases. So whenever there is a sales return or a purchase return, these sales return or the purchases return should be deducted from their respective heads. That is, if it is a sales return, it should be deducted from your gross sales. If it is a purchase return, it should be deducted from your gross purchases, because when we deduct these returns from sales and purchases, what we get net purchases or net sales. That is, net means after adjusting your returns, because when it is a return, it means it has not converted into a transaction, so it has to be adjusted. And in profit and loss account, we write net purchases and net sales, that is after adjusting for your returns. So let us see one more important concept which is related to when we prepare your profit and loss account statement. That is called as cost of goods sold. The name itself says the cost of goods sold. That is, what is the cost of the goods which has been sold or which is to be sold. So how to calculate that? So cost of goods sold, the formula to calculate the cost of goods sold is that you add the opening stock. Now this opening stock is to be the opening stock of raw materials. When I say opening stock, it is opening stock of raw materials when we are calculating the cost of goods sold. Then we add purchases. This is the purchases is a raw material purchase. It is a purchase of raw material, and we add all the direct expenses. Now what are the direct expenses? Direct expenses are those expenses which you can directly attribute to the product which is to be sold. So those expenses which are directly a part of your product which you are selling. For example, the labor, the wages which you are paying. Okay, then you are paying for some freight or rock try or some charges. Then if you are paying any kind of a duty, these are all direct expenses which can be directly attributed to the product. They are called as direct expenses. So when we calculate the cost of goods sold, we have to take the opening stock of raw material, we add the purchases which you have made of the raw material during the year, and then we have to add the direct expenses. And from that we subtract the closing balance of raw material. Now what is this opening and closing balance, closing stock? Whatever is the opening balance or opening stock of raw material at the beginning of the accounting year, it will become opening stock. And whatever is remaining at the end of the year, that is on 31st of March of that particular year, it will become your closing stock. So definitely in everywhere we will find two kinds of stock. So one stock has to be added because we start the year, we start the production with this opening stock. We already have a stock, then we make the purchases. So stock plus purchases, then we made certain expenses, and then at the end of the year, whatever is remaining, definitely it has to be deducted. Why? Because it is still remaining. It cannot become a part of your cost. So it has to be deducted. So this equation will give you the cost of goods sold, and it is very important to calculate this or to understand this cost of goods sold when we are calculating the profits in your profit and loss account. Why? Because the gross profit is the result of this cost of goods sold. Now let us see the next one. That is a gross profit or gross loss. I told you that this cost of goods sold is very important to calculate the profits or the losses. So now gross profit. Basically when we prepare a profit and loss account statement, we divide the expenses into two categories. One is direct expenses and another is indirect expenses. So if when we consider only the direct expenses, they become a part of your cost of goods sold. So if you have taken only the direct expenses, it will become a part of your cost of goods sold, and that cost of goods sold, when you deduct from your net sales, it will become your gross profit. But for that, your sale should be more and your cost should become less. So when your sale is more and your cost is less, it will become your gross profit. But if it is vice versa, the cost is more, the cost of goods sold is more and your sales is less, then it will become your gross loss. So then we prepare this profit and loss account. This gross profit or gross loss will tell you that, okay, this is what the sales minus the direct expenses to which you have incurred to produce or to make that particular goods or services. This is the gross one. In that you have not included the other indirect expenses. Okay. So next, revenues. Now, when we prepare this profit and loss account, we have to understand the concept of revenue. When we say revenue, revenue means all incomes. But we have to understand that when we talk about incomes, there are two different categories of income which are there in your profit and loss account. One is the income from operations. We called it as operating income. This is the income which is the result of your operations, whatever is your business activity. For example, if you are into a hotel business, so whatever is the income from that hotel, that is your operating income. But along with that, if you have some other properties also which you have given on rent, so that rent which you are receiving from other properties is also your income, but it is not your operating income. Why? Because giving the properties on rent is not your business. You had some extra properties, so you gave it on rent. So that rent is your income, but it is not your operating income, because your business activity, your commercial activity is running a hotel. So income from hotel is operating business, but whatever rent you have received from other properties, that is also income, but it is a non-operating income. So when we add these two incomes, operating and non-operating, it will become your total income, or we can call it as revenue. But in accounts, it is very required that you should differentiate between what is your operating income and what is your non-operating income. Now, as we have talked about revenue, it is very important to talk about the expenses also. Now, whatever expenses, whatever cost the business is incurring on earning the revenues, that will become an expense. And then we have to record the expenses also. But what expenses have to be recorded in your profit and loss account statement? So whatever cost you are incurring for earning the revenue, it should be recorded. But only those expenses should be recorded in your profit and loss account which are the benefit of which has been received in that accounting year and expire in that accounting year. That is, when we record the expenses, we have to record the expenses which are of recurring nature. That is, continuously on a regular basis, the business has to incur these expenses. Okay, for example, business purchased a building and business paid for your rent. Two different expenses are there. One is buying a building and another is paying for your rent. So similarly, we will say both are expense because you paid for the building and you paid for the rent also. But the accounting concept says that when you are recording the expenses, something as an expense in your profit and loss account, then only those expenses should be recorded which the benefit of which has been received in that particular year itself. That is, rent you paid in this year and the benefit of the rent you are going to enjoy in this year itself. But what you have purchased as an asset, the building which you have purchased as an asset, the benefit of that particular building is not going to expire in this particular year. You are going to enjoy the benefit of that particular building for a longer period of time, maybe 5 years or 10 years. So that means the benefit will be enjoyed for a longer period of time. So that is why this is the expenditure which you have made on asset. This is a buying of asset, so it should not be recorded in your profit and loss account. Okay, so only those expenses have to be recorded in your profit and loss account which are related to that particular year for which you are preparing your accounts, and along with that you have to understand that those costs should be recorded, those expenses should be recorded, the benefit of which is going to be received by the business only in that particular year. We can also call it as expenses which are of revenue nature. This is another concept which is very important, that only revenue nature expenses, recurring expenses, the expenses which have the tendency of recurring again and again. Why they have a tendency of recurring again and again? Because their benefit lapses very soon. If you paid rent, the benefit is only for 1 month. You paid salary, the benefit of it will be received by you only for 1 month. So only those expenses should be recorded, the benefit of which has been received and expired in that particular year. Now, depreciation. Whenever we prepare accounts, profit and loss account, we have to record for the depreciation also. Now, what is this particular term called as depreciation? In a business, we use a wide variety of assets, and these assets are used for earning profits. These assets are used for production, These assets are used for sale. These assets are used for earning revenues or profit. We are using these assets. When you use these assets, so somewhere these assets are also contributing in the earnings of the business. So the value of these assets has definitely, it is going to decrease because you are using it in your business to earn the profit. So whatever is the decrease in the value of asset, that decrease should also be recorded as an expense in the profit and loss account. If I purchased a building for 10,000 rupees and I experience, or I think that it is going to last for 5 years, it means 10,000 for 5 years. That means every year on an average, I'm going to use the value of rupees 2,000 of that building in my business. 10,000 for 5 years, it means every year 2,000 benefit or the value of the building will be utilized in my business to earn the profit. It means every year, what is the value of the asset which I have used? That is 2,000. What is the decrease in the value of that building? It is 2,000. It could be, the reason can be different. I'm using it because of wear and tear, the building become obsolete, the building collapsed, or anything could be there. So any reason because of which there is a decrease in the value of asset, we have to record that decrease in our profit and loss account statement, and this is recorded as an expense. Depreciation is charged as an expense in your profit and loss account, and it has to be deducted. When we prepare the balance sheet, then what we will do with this depreciation? So when we prepare the balance sheet, whatever is the value of that asset in the balance sheet, if I say building was of 10,000, to this year I charge 2,000 rupees as depreciation. Okay, so this year I charge 2,000, so my balance sheet will show that building was of 10,000, but this year I used 2,000 rupees of value. So that means now only my building, the value of building at the end of year is only 8,000. So that means you charge depreciation in your profit and loss account, and simultaneously the decrease in that value of the asset should be shown in your balance sheet. That decrease should be deducted from the value of the asset in the balance sheet also. So depreciation should be shown as an expenditure in your profit and loss account. Now operating income. What is that operating income and operating expense also? I told that what is operating income? The income which is outcome of your operations. That is your operating income. Whatever is your commercial activity, whatever is your business activity, the income which you are generating, the income which you are earning from that activity is your operating income. Sale of goods and services, it is your operating income. So you have to differentiate between operating and non-operating income. So all the incomes which are the result of your operations is your operating income. Then what is operating expense? To operate the business, to receive, to earn the operating income, whatever expenses you have made, whatever expenses you have incurred, that is your operating expense. So the expenses incurred to earn the operating income are your operating expense. So we can also say that what is operating expense? The expenses which are incurred in operating or running a business. So this is your operating expense. Then what is that? What is operating income? How you will calculate it? One way we have is gross profit minus operating expenses. You will get your operating income. We have already seen how to calculate the gross profit. Gross profit is your net sales minus cost of goods sold, and then you receive the gross profit. Now from the gross profit, if you deduct all your operating expenses, it is your operating income. The examples of operating expense: all salaries, all taxes, all insurance, all your marketing expenses, advertising expenses, these are all your operating expenses. Why these are operating? Because they are very much required for the smooth running of the business. If you don't pay for these expenses, the business is not going to run. So these are the expenses which are required to operate a business, and that is why we call them as operating expenses. So all the necessary expenses for the smooth running of a business are your operating expenses, and all the incomes which are the result of your operations, your commercial activity, your business activity are your operating incomes. So students, In this lecture, we have seen that what is a profit and loss account statement and how it is related to your balance sheet. How these two statements are related to each other, what is the relationship and how they affect each other. We have also seen where some of the important terms which we have to understand when we are preparing a profit and loss account statement, because these are the terms which will help you to understand and to calculate the accurate profits of the business. So I hope that after going through all these concepts and after understanding the profit and loss account statement and the balance sheet relationship, we are in a better position now to move forward and to understand that how actually we are going to prepare the profit and loss account statement. So thank you for the lecture, and we will be meeting for the third part of it. Thank you.